Hey, it's Jack. Thursday morning, market's up. No surprise there. It's been really on a tear. Almost a little too much too soon. If you look at a chart of the SPY, DIA, or QQQ, you'll see a real sharp rise. And that's great. And I'll tell you a little stock trading strategy that I love right now. What I like to do is find stocks that have made a new 52-week high. Now that's the single best place you can start when you want to find a stock. And this goes right along with my strategy of buy high, sell higher. Remember that. Almost everybody talks about buy low, sell high, and I don't know how to do that because how do you know what's low, right? If you're going to buy low, what is low? When you buy high and sell higher, finding a stock that's already high is easy. You start off with a stock that's made a new 52-week high. That's the single best place to start. Now, just because it hit a new 52-week high doesn't mean it's a good stock to trade. It also has to have been in a trend for at least 4 to 6 months. So pull up a 6-month chart of a stock that made a new 52-week high. And if it just spiked up for some reason, that wouldn't be a buy. But if it's just trending higher and it made a new 52-week high, that's probably a really good place to start. That's what I like to do. I just want to make sure that the stock trades on a major exchange, has 500,000 shares average daily volume. It's over $25 a share. It has at least 500,000 shares average daily volume, like I said, so you get some good liquidity, right? And optionable. Now that's a really good place to start. And if you find a stock that's made a new 52-week high and it's in that trend and it meets all that stock criteria I told you about, I just like to buy it at the market. Then what you can do is place 2 orders if you can. This is called one cancels other. You place one order above the price you paid for the stock where you'd like to see your profit target at. You place another order 7% below the price you paid for the stock to protect yourself. So the most you could lose is 7%. Now, if you can put both orders in at the same time, it's called an OCO, which means one cancels other. That means if the stock goes up and hits the price on your limit order to sell it above your purchase price, you're going to lock in your profit. And that's then going to automatically cancel the order you had in below it. And vice versa. If the stock drops 7%, you're going to be stopped out, limit your loss, and that's going to cancel the order you had at a higher price to sell. One cancels other. Now, if you can't do that and you can only use one, then just use the stop 7% below the price of your stock. And you may have an opportunity to use a trailing stop. And what that does is that stop order will trail up as the stock price goes up, and then it'll stop. Okay? So that's a really good technique you can use if you're not watching your stocks all the time. Hey, we're ripping into 2024. Stay tuned. I got a lot more for you.